Hello, guys. Welcome back to my YouTube channel. Today, I'm going to be making a video about automating your savings. And like you all know, I am very interested in your journey to financial independence. I am in the journey myself, right? So, but I've decided to start this channel to give nuggets, financial nuggets on how or what I am implementing and how I'm implementing it so that it can help you also in your journey. So leave a comment below if you are doing something unique that is helping you out in this financial independence journey. And I'd like to collaborate with you or do some more videos, or if you have any insight as to what videos you would want me to do, I would like to see your comments. And I also want to invite you to subscribe to my YouTube channel, and that helps me do more amazing and awesome videos. So today I want to talk to you guys about, automating your finances. What do I mean by this? Automating your savings. What do I mean by this? So finance is a personal journey, and there are many advice out there, right? Some people are on the conservative side, while some are a little bit on the aggressive side, right? So eventually there is Dave Ramsey over there, and then there is Robert Kiyosaki over here. So Dave Ramsey believes that you don't need debt to be able to do whatever you want to do. Just save up and then deploy that wealth in something, build a business, but no debt, right? And then there is Robert Kiyosaki that believes that there are good debts and then there are bad debts. So good debts are debts that make you money. They are debts that, assuming you want to buy a commercial building and that commercial building costs like $1 million, you only have 100,000, right? So with debt, with leverage, you could actually control that property and make money as if you own it, right? So you make money on a $1 million assets as if you own it, right? And then from the debt that you took, say you have 100,000, right? So you borrowed 900,000 to be able to finance that building, and that building is making money, and from the money that the building is making, you are able to pay back the monthly mortgage on that particular building. So Robert Kiyosaki believes that that's a good way to build wealth, and I subscribe to that ideology. I believe that there are bad debts and there are good debts. I don't subscribe to credit cards from all these commercial stores that want you to get their credit card so you can come and spend money in their stores. No, I don't subscribe to that. The only credit cards that I get are credit cards that pay me back, that pay me cash back at the end of the day, right? So back to the intent of this video. There are so many advice out there. Finance is a personal journey, so you have to decide what path you want to take, right? So decide who your mentor is going to be and stick to that. So if your goal is to become financially independent and win in the game of money fast, then you must have to learn the principles of savings. You must have to learn the principles of debt. You must have to understand how debt and savings work. What are the dynamics, and how are you going to deploy your savings into an investment vehicle that is going to help you achieve financial independence as fast as possible. So that's your goal. Unfortunately, you have to do that yourself. Nobody can do that for you. So with financial independence, it's a journey that you have to take for yourself. It's a journey that you have to carry your family along with you as you take that journey. Unfortunately, it's a very long-term journey. It's a very long-term journey. So there's the reason why you have to start now to plan and to execute your plans. So you are not gonna, unless you win a lottery, unless you have like a windfall of money coming into your account, from your dad or your mom, from life insurance and all that. So that's That's a use case of its own, and it's not usually normal. Everybody doesn't have the same testimony around that, right? But if you have a job, you have a W-2 job, you have a work that you are doing, or even if you have a business that is generating monthly cash flow for you, you have to plan. Now, what is financial independence? In summation, it is just the concept that you don't have to answer to anybody again. You have your finances on your own terms. You live life on your own terms. That is just what financial independence is, right? So you have enough assets that are producing monthly cash flow for you to sustain either the current lifestyle you have or the future lifestyle that you want to have. That is financial independence in a summation. So for us to get to financial independence, you must have to have your savings in order. Like I will usually tell every one of you that your savings is your springboard into your finances, into your financial independence. Why is that? Because it's from your savings that you have to invest. It's from your savings that you have to choose what financial vehicles to put your money in. So let's get back to automating your savings. Now, I do encourage people to get into the 50, 30, 20 framework. So where your 50%, the 50% of your income that is coming in into your account is going to your need. The 30% is going to your wants. And then the 20% is going to your savings. Now, this is not a static framework by itself. It's very, very dynamic. So you might decide that this particular year or even this particular month, you want to do 70, 20, 10. Whatever works for you. But the idea is that you have to be consistent. That is the whole goal. You have to be consistent in making sure that money goes into your savings bucket. How are you going to become financially independent if you don't save money? How do you want to accomplish that? That is the doorway. That is the pathway for your financial independence. And if you have not been saving, this is an opportunity for you to start saving. Some people think, I want to work till I'm 60. Those are the old ways. Our dad and our mom, they were taught you have to work until you are 59, until you are 60, and then you retire. No, you don't have to wait until you are 60 to retire. You can technically retire before you are 40. You can technically retire before you are 50. All I'm saying is that by the time you are 50 years old, you should have enough assets that is paying money into your account on daily basis for you to sustain the lifestyle that you've got. That's all I'm saying. So this whole mindset that you have to retire at 59 and 60, that's the old way. That's the old system. You don't have to operate the old system again. This is the new system. Retiring early, retiring rich. That's the new system. So back to automating. Number one thing I want you all to do is at least you must have to build your emergency fund. Building your emergency fund or getting a personal line of credit, right? So this would make sure that you are prioritizing building your emergency fund to cover unexpected expenses. You are aiming at 3 to 6 months worth of expenses, right? So you calculate, I as a person and my family, we need about 3,000 every month to sustain my mortgage, to sustain my feeding, to sustain everything that we need for that particular month, right? So you need 3,000, you multiply that by 3, then you save 9,000 in a bank account, right? Or if you want to do 6 months, 3 by 6, it's 18,000. You save that in a bank account, right? Usually a high interest bank account so that the money can be paying you interest on a monthly basis, right? So the goal of automating your savings is to make sure that you are not tempted to touch the money when you see it coming into your checking account. That would help you to make sure that you are saving this money and make sure that it's being kept in a safe place. Because some people, once they see that they have $1,000 coming in, their wants would expand. And that is something with the human nature, right? Our wants usually expand whenever our means increases. So what do I mean by that? If I am now I was making like $1,000 every month, right? And all of a sudden my manager wants to promote me so I can be making 1,500 every month. All of a sudden your want will start to expand, right? You see all those things that you couldn't afford when you were making $1,000 and you want to afford it right now. So that's what happens. That's the dynamics. This is where discipline comes, right? Because your goal is for the future. Your goal is to become financially independent in the future. So right now you must have to delay gratification. It's an important word in personal finance. You have to delay your gratification because you have a future goal. You know, there is this passage in the Bible that says that when there is no vision, the people cast off restraint, right? So if you don't have vision of financial independence, how are you going to have the restraints that are needed for you to become financially independent? You can't have it because you don't have the vision. So the vision is becoming financially independent in the future, right? And then you set the constraints. The constraint is that if my paycheck is increasing, my wants are not increasing. I do not want any Louis Vuitton bags. I don't want any Chanel bags. I want to maintain the one I have right now. To even better solve the equation is invest the capital you are making right now, and then from the proceeds of that capital, you could afford the Chanel bags. That's the better equation. And that is what I'm doing, right? So, assuming you have the checking account that is synced up with your work, right? You could ask your work people to basically set that percentage for you, right? So you could give them two different bank accounts. One bank account for your savings and one bank account for your checking. So divide that upfront so that you don't even get to touch it, right? So let's that 20%, you give them your savings account, your account routing number, account number, and everything. Let that 20% go straight on to your savings account. Now, these are people that might need a little bit help for, establishing this framework. There are some other people that you just give your work people just one bank account, but then you had to set up a recurring transfer from your checking account into your savings account. So that would definitely help you to make sure that you are not overlooking your savings. So overall, your savings needs to be in a very high interest yielding account. You can check the videos that I have. Some of the videos that I have, I've been talking about savings for quite a while now because I'm a beneficiary of it. I'm a beneficiary of the discipline of saving because that helped me to pay my tuition when I was in school. It was from the aggressive saving that I was doing. That was how I was able to afford paying my college tuition, obviously with additional scholarships that I got, right? So remember, your savings act as a buffer, cushioning what is going on, the financial stress that is going on out there and your own personal finance world. It acts as a buffer. And then it also acts as a springboard for you to find investment vehicles, that are out there that you can invest in and grow your money from there. So overall, the long-term goal is for you to move from your savings into investments. But you have to get the framework of your savings correct before you make that jump from savings to investments. I hope this video has been very insightful for you. I hope to be coming through more and more with insightful videos. So please go ahead and subscribe to this channel. Like this video, comment on this video. It helps my channel's algorithm, right, to deliver these videos, this quality content to more people out there. So thank you for watching today. I hope this has been great insight for you. Stay blessed. Bye-bye.